Valuations are stretched, interest rates are high, earnings are declining. One catalyst, and everything collapses. Here's what that catalyst might be. Most investors are ignoring the massive risk building in their portfolios. This video reveals what trigger event could set off a major market decline and what you need to do about it. You're sitting in your house right now, probably checking your investment portfolio on your phone or your computer. You're looking at your 401k balance. You're looking at your brokerage account. You're looking at your retirement savings. And everything looks fine. The stock market has been going up. You've been making money. Your portfolio is growing. Life is good. But here's what you need to understand. Something absolutely unthinkable is about to happen to stocks. And if you're not prepared for it, if you don't understand what's coming, it could absolutely devastate your retirement plans. See, most people have this assumption that the stock market is basically safe. They think it always goes up over time. They think that if you just buy and hold, if you just stay the course, you're going to be fine. And while it's true that the stock market has gone up over very long periods of time, the reality is that there are periods, sometimes long periods, where the stock market doesn't go up. It actually goes down. And sometimes it goes down dramatically. And right now, we're at a point where all the conditions are lining up for something absolutely unthinkable to happen in the stock market. And I'm going to tell you exactly what that is and exactly what you need to do to prepare. My name is Clarence, and I spend way too much time analyzing market conditions and trying to understand what's actually going to happen in the economy and the stock market. Don't forget, like this video and subscribe to the channel. I read a lot of data. I look at historical patterns. I analyze what central banks are doing. I analyze what geopolitical events are happening. EGK based on everything I'm seeing, based on all the data and all the analysis, I believe that we're heading towards something in the stock market that most PGK are completely unprepared for. Most PGK are going to be caught off guard. Most people are going to panic. And most people are going to make really bad financial decisions at exactly the wrong time. But you don't have to be one of those people. If you understand what's coming, if you understand the mechanism that's going to cause this, if you understand what you need to do GGK, then you can actually position yourself to not just survive it, but potentially even benefit from it. Let's start with the obvious thing that everyone is worried about, but nobody wants to talk about openly. And that's the fact that stock valuations are at historic highs right now. When you look at traditional valuation metrics like the price-to-earnings ratio, the dividend yield, the price-to-book ratio, stocks are more expensive than they've been at almost any point EGK. That doesn't necessarily mean the market is going to crash tomorrow. EGK doesn't mean that stocks are going to EGK immediately. But it does mean that we're in an environment where stock prices are stretched. We're in an environment where there's a lot of risk. We're in an environment where if something goes wrong, if sentiment changes, if something spooks the market, we could see stock prices fall very quickly and very dramatically. Here's the unthinkable thing that I think is about to happen. I believe we're heading toward a sustained bear market that could last anywhere from 1 GDK years. Now, most people have never experienced a sustained bear market. If you're in your 40s, if you're in your 50s, you might have experienced the 2008 financial crisis, which was a bear market. You might have experienced a brief bear market during the pandemic, but that one only lasted a couple of months before the market recovered. A sustained bear market is different. A sustained bear market is where the stock market drops and then stays down. It might bounce up and down, but the overall trend is downward for an extended period. And during that time, portfolios decline. Retirement accounts decline. People's wealth gets wiped out. And most importantly, people's psychology gets completely destroyed. They panic, they sell, they lock in losses. And by the time the market recovers, they've missed the recovery because they sold at the bottom. Now, what would cause this sustained bear market? Well, there are a number of factors that are lining up right now. And when you combine them together, they create a really scary picture. First, interest rates. The Federal Reserve has been raising interest rates to try to control inflation. And when interest rates go up, stock valuations go down. The reason is that stocks are valued based on the future cash flows they're expected to generate. When interest rates go up, those future cash flows are worth less in today's dollars. So, stock valuations decline. We've already seen some of this happen, but if interest rates continue to go up, or if they stay elevated for a long period of time, stock valuations could decline significantly. Second, corporate earnings are starting to decline. Companies are dealing with higher costs due to inflation. Companies are dealing with higher interest rates if they have debt. Companies are dealing with reduced consumer spending because consumers are spending more money on necessities due to inflation. So profit margins are being squeezed. Earnings are declining. And when earnings decline, stock valuations have to decline to match. A stock that was worth $100 per share when the company was earning $5 per share is not worth $100 per share if the company is only earning $3 per share. Third, there's a lot of debt in the economy. Corporate debt is at all-time highs. Government debt is at all-time highs. Consumer debt is at all-time highs. All of this debt was accumulated during a period of very low interest rates. But now that interest rates are going up, servicing that debt is becoming more expensive. And at some point, debt starts to default. Companies start to go bankrupt. Consumers start to default on their debts. When that happens, it creates a cascading series of problems throughout the financial system. Banks start to fail. The stock market sells off, and suddenly, we're in a crisis. Fourth, geopolitical tensions are rising. The situation in the Middle East is unstable. Relations with China are tense. Russia is still aggressively pursuing its war in Ukraine. All of these geopolitical tensions create uncertainty in the markets. When there's uncertainty, investors get nervous. When investors get nervous, they sell. And when they sell, the stock market goes down. Fifth, there's a lack of enthusiasm for stocks among actual investors. If you look at the data on how much money is flowing into stocks versus how much money is flowing out, if you look at sentiment indicators, if you look at the levels of enthusiasm among retail investors, you see a market where enthusiasm is waning. Most of the gains in the stock market right now are being driven by a small number of mega-cap technology stocks. When you look at the broader market, when you look at the average stock, you see a market that's actually declining. So we've got a situation where the market is being propped up by a small number of stocks. And when those stocks start to decline, the entire market is going to have nothing to support it. So here's what I think is going to happen. At some point in the next 6 to 18 months, we're going to see a significant catalyst that spooks the market. It could be a bank failure. It could be a corporate bankruptcy. It could be a geopolitical event. It could be an earnings disappointment from one of the mega-cap technology stocks. Whatever it is, it's going to be something that makes investors realize that things are not as safe and secure as they thought they were. And when that happens, when investors realize that risk is higher than they thought, they're going to start selling. And once they start selling, it's going to create a cascade. More people sell because prices are going down. Prices go down more because more people are selling. Pretty soon, you've got a sustained decline in the stock market. Now here's the thing that's really important to understand. This kind of thing has happened before. We've seen sustained bear markets before. The bear market from 2000 to 2002, the stock market lost about 50% of its value. The bear market from 2007 to 2009, the stock market lost about 57% of its value. These are real things that have happened, and when they happen, portfolios get cut in half. People who thought they were going to retire find out they can't. People who already are retired find out they don't have enough money and they have to go back to work. People panic. People sell at the worst possible time. And by the time the market recovers, they've lost a huge amount of wealth. But here's the thing that's most important. If you understand that this is coming, if you prepare for it, you can actually not just survive it, but potentially benefit from it. The people who do well during bear markets are the people who were prepared. They're the people who had cash on the sidelines. They're the people who understood that this was coming. They're the people who stayed disciplined and didn't panic and sell. They're the people who actually bought stocks when prices were down, and by the time the market recovered, they had made a lot of money. So what should you actually do to prepare for this unthinkable event that's about to happen to the stock market? Well, the first thing you need to do is understand that the stock market is not guaranteed to go up. You need to get rid of the assumption that the stock market always goes up over time. Yes, historically, over very long periods, the stock market has gone up. But there are periods, sometimes long periods, where it doesn't. And if you're in your 60s, if you're close to retirement, you don't have 30 years for the market to recover. So you need to be realistic about the risks. The second thing you need to do is reduce your exposure to stocks if you're close to retirement. If you're going to need to start withdrawing from your portfolio in the next 5 years, you should not be 100% invested in stocks. You should have some allocation to bonds, to cash, to other assets that are not stocks. This reduces your risk. Yes, it might mean lower returns if the market goes up, but it also means lower losses if the market goes down. And if the market goes down right when you need to start withdrawing money, that's a disaster that you want to avoid. The third thing you need to do is build up cash reserves. You should have enough cash on hand to cover your living expenses for at least 1 to 2 years. If the stock market crashes and you're in retirement, you don't want to be selling stocks at the bottom to cover your living expenses. You want to have cash on hand so you can cover your living expenses without selling stocks. This allows you to wait out the bear market and sell stocks when prices have recovered. The fourth thing you need to do is diversify your portfolio. Don't be 100% in stocks. Don't be 50% in stocks. Have a diversified portfolio that includes stocks, bonds, cash, real estate, commodities, whatever makes sense for your situation. When stocks are down, other assets might be up. This provides some protection. The fifth thing you need to do is think about whether you should shift some of your money into value stocks or other assets that might do better in a bear market. Certain types of stocks, certain sectors, do better than others during bear markets. Gold tends to do well. Bonds tend to do well if interest rates are falling. So think about how you can structure your portfolio to have some assets that will do okay if the market goes down. The sixth thing you need to do is mentally prepare yourself. If you understand that a bear market is coming, if you understand that stock prices are going to fall, if you understand that your portfolio is going to decline, then when it happens, you won't be shocked. You won't panic. You'll remember that this is something you expected. This is something you prepared for. You'll stay disciplined. You won't sell at the worst time. The seventh thing you need to do is think about whether you can actually retire if the market crashes right now. If the stock market crashes tomorrow and your portfolio falls 50%, will you still be able to retire? Or will you have to go back to work? If the answer is that you'd have to go back to work, then you need to either work longer, save more money, or reduce your retirement spending expectations. Because if you retire right before a bear market and your portfolio is cut in half, you're going to be in a really bad situation. The eighth thing you need to do is think about your income situation. If you're still working, if you have income coming in, you're in a decent position to weather a bear market. You can keep adding to your investments. You can buy stocks when they're cheap. But if you're already retired and you're living off your portfolio, then a bear market is much more dangerous. So think about whether you should extend your working years, whether you should build up more savings before you retire, whether you should have some other source of income in retirement. The ninth thing you need to do is think about whether you actually believe that this unthinkable thing is about to happen. Because if you don't believe it, you won't prepare for it. You'll just keep doing what you're doing. You'll stay 100% in stocks. You'll assume the market is going to keep going up. And then, when the bear market hits, you're going to be devastated. So you need to really think about whether you believe the analysis, whether you believe that valuations are too high, whether you believe that a bear market is coming. And if you do believe it, you need to act on that belief. The 10th thing you need to do is have a plan for what you're going to do during the bear market. Are you going to stay invested? Are you going to buy more stocks when prices are down? Are you going to rebalance your portfolio? Are you going to do nothing? Having a plan ahead of time means that when the bear market hits and emotions are running high, you won't make emotional decisions. You'll just execute your plan. Here's the thing that's really important to understand. I'm not saying you should sell all your stocks and move to cash. I'm not saying you should panic. I'm not saying the market is going to crash tomorrow. What I'm saying is that conditions are lining up for something unthinkable to happen. Valuations are stretched. Interest rates are high. Corporate earnings are declining. There's a lot of geopolitical risk. There's a lot of debt in the system. All of these things together create an environment where a sustained bear market is more likely than at any point in the last decade. And if you're not prepared for it, if you haven't thought about how you're going to handle it, if you haven't positioned your portfolio for it, then you're taking a risk that you might not fully understand. But if you do prepare, if you do understand what's coming, if you do position your portfolio defensively, then when the bear market hits, you won't be devastated. You might not make money. You might experience some losses. But you'll be able to survive it. You'll be able to stay disciplined. You'll be able to wait for the recovery. And when the recovery comes, you might even be in a position to benefit from it because you'll have cash to buy stocks at low prices. So here's what I want you to do right now. First, take a cold, hard look at your portfolio. How much of it is in stocks? How much is in bonds? How much is in cash? If you're close to retirement and you're more than 70 or 80% in stocks, you might want to rebalance. Second, think about what would happen if the stock market fell 50% tomorrow. Could you still retire? Would you be okay? If the answer is no, then you need to save more money or plan to work longer. Third, build up some cash reserves. Start putting money into a savings account. Get yourself to the point where you have at least 6 months to a year of living expenses in cash. Fourth, diversify your portfolio. Don't be 100% in stocks. Fifth, have a plan for how you're going to handle a bear market. What are you going to do? Will you stay invested? Will you buy more? Will you do nothing? Decide in advance so you don't have to make emotional decisions when the bear market hits. The unthinkable is about to happen to stocks. Most people are not prepared. Most people are going to panic. Most people are going to make bad decisions. But you don't have to be one of those people. You can understand what's coming. You can prepare. You can position yourself to not just survive it, but potentially benefit from it. The choice is yours. Make it now while you still have time. That was your friend Clarence Capital. Don't forget, like this video and subscribe to the channel. Check out the next video. Take care of yourself, your finances, and most importantly, your time. Good luck.